Welcome back. It's been a minute since we were forced to do this thing by marketing. It's been 3 quarters, give or take.
Yeah.
Yeah, 3 quarters, give or take. And the last time we were here, we were talking about the different valuation methods, or rather, how to value a company. We talked about intrinsic valuation,
Relative valuation, option pricing.
and option pricing, right? And so this time round, I decided it's best if I invite my friend here. So I'm Isaac Munene, a corporate finance analyst at Genghis Capital.
I'm Wesley Manambo. I sit at the research desk and welcome. This is Valuation 102.
So, Wesley, tell me about something about relative valuation.
Well, I think relative valuation is one of the easiest ways to do valuation. Two factors considered. Number one, it's not time consuming. And number two, it's something common. I mean, you've done relative valuation, and I believe our listeners have done it before. Take an example, going to buy a car. You go, let's say you want to buy a Vitz. It's a 2014 model, 200,000 miles. You'll want to check, okay, in the market, how are similar vehicles trading? How much are they selling for? You want to call a mechanic, do an engine overhaul, see the wear and tear, then price it based on that aspect of the valueness that the car is bringing to the table. You'll just assume, oh, it's a 2014 model, this mileage, relatively in the market, it goes for 800,000, so I'm willing to pay 800,000. That you value this car based on something else, an underlying, assuming that the pricing of that was either close or at the estimated intrinsic value.
Okay.
So you find relative valuation is something quite interesting. It's prices in the bias. If it's changing market sentiments, changing valuation assumption, it really bakes that in quickly. That's my highlight of relative valuation.
Well, I started laughing at when he almost lost me at cars. For car lovers, we started thinking about a side mirror, a tire. Well, for businesses, there are certain comparables you look at. So you can compare a Vitz to a Mercedes. No offense to the Vitz owner. But for businesses, there are certain comparables that are standardized across when you're doing relative valuation method. So some of these comparables are like price to equity, EV to EBITDA. And for people who are very advanced in business, you can come to realize that there's a pattern in the numerator and a pattern in the denominator. So for the numerator, it basically describes the price of the company. So you'll come to notice a pattern in the numerator is that it focuses more on the price or the equity value, and for the denominator, it factors on an underlying aspect of the business, be it in operation or be it in the sales, be it in the revenue they're generating. So a good example of this comparable is price to equity, price to book. We have EV over EBITDA. So EV is a price of the company, the equity value, and EBITDA, this is the earnings before interest, tax, depreciation, and amortization. And that is an operating aspect of the business. Do you have any other comparables I might have missed?
Actually, focusing on the comparables that you mentioned about, it's quite important to note that depending on the life cycle of the business, some outweigh each other. For a young business, you'll be keen on the EV over EBITDA because you have to see the revenue lines growing as expected. For mature business, you'll be keen on the book value. So price to book to the net asset value will be key. Let's say for a company that has growth prospects in the BCG matrix, maybe it's falling on the cash cow, the cash cow quadrant. You'll be keen on the price to equity because you have to see price to earnings. You want to see how much am I paying for the company is generating on average. So each single matrix does not give a clear picture. Together they give a more compatible picture. You want to see the earnings value of the company in terms of its book value. What am I buying? Am I buying at a discounted entry level? Am I paying more? Am I paying less? And also you'll find on average with PB you'll want to pay less. You'll want to pay less for something more. But then again you'll find sometimes a PB of 1.2 is not high, especially for telecommunication companies, maybe at times, or even tech companies. They tend to trade a little bit higher than the book value. So when you look at it as a standalone, it may give you the picture that I'm really paying so much for the business, but then depending on the industry trends and also premiumization, per every sector, it gives you a clearer picture, which really speaks to the assumption that you make with relative valuation. First, you've talked to the aspect of assuming these are comparables. You're assuming they're similar in pricing, they're similar in market penetration, in terms of operational dynamics, they're similar. Second has to be that aspect of assuming that price is standardized. For instance, the pricing of a telco across the board is similar. If I use a telco in Nigeria, telco in Kenya, telco in Ghana, you'll assume that prices are similar, but that's a very big assumption. And now to control that aspect, you have to really bring in that aspect of realizing actually not all the time is price similar, so you have to account for bias. Now this has to bring in the aspect of, let's say you want to look at Airtel Kenya against Safaricom. Those two companies have the same regulators, they have the same market, they're serving the same market, they're facing the same macroeconomical outlooks, but then you find in the operational dynamics that's different. So you have to bake in some bias. So if you're valuing, let's say, Safaricom based on Airtel, you have to bring in a premium factor because it has a higher market share, it's enjoying some benefits that the latter does not. And if you're valuing a smaller company from a bigger one, you have to really bake in the discounting factor, because you have to assume pricing is standardized, but in the event that it's not, you really have to account for that. So that's really key in relative valuation, in my view.
Okay. For our viewers, I personally have a bias towards a different method of valuation. So I think I'll highlight the cons of relative valuation method, while Wesley on the other side will highlight the pros of relative valuation. So I, as an analyst in the M&A sector, basically I prefer using discounted cash flow. Well, it has its cons, but we'll not talk about that today. But for relative valuation method, I think I'll highlight the biggest problem is the standardization of the comparables, considering that, as he had mentioned, price is different in different telcos because of different countries, because of different regulations. Operations also is very different. So a good example, you can look at EV over EBITDA, EV being equity value divided by the earnings before interest, tax, depreciation, and amortization. So if you look at it in a company that borrows a lot, you can tend to come and realize that this company is really huge because it makes the EV over EBITDA huge, as compared to the reality on the ground, as people like to call it.
Well, pro for this, I'll say it's quick to really conduct a relative valuation. And again, there's that aspect of baking in bias. Different analysts will have different biases. We may choose the same data, the same set of assumptions, but we'll come to a kind of different estimate. So there's that aspect of really baking in all these dynamics, and it gives you the consensus view. So with relative valuation, it takes into account the consensus view. And the best way to put it is, if you think my estimate is crazy, you just need to see the other analysts down the hall. So it kind of balances both, and we know pricing at the end of the day is driven by the consensus view. That's a strong one.
Okay. Well, folks, as Wesley has put it, he likes to be wrong when everyone else is wrong, and he likes to be right when everyone else is right. I think I'm of a different opinion, but these are one of the different methods that we use in the valuation of companies, and I do it in the mergers and acquisitions. Wesley does it in the research. And so here at Genghis, we are well conversant with the different methods of valuation. The intrinsic value, that is the discounted cash flow. If you've forgotten, please have a look at our previous video. We have the relative valuation, and we have the option valuation method. And these different methods are all factored into account when giving recommendations and also when valuing your business. So welcome at Genghis, and we are sure to provide you good quality and service. Thank you.